Good morning. This is Larry McMillan with a stock market update to open the new year on Monday, January 3rd, just as the market is opening. So we're opening to the upside right now in S&P and the futures, and the S&P chart is positive, and it's been at new highs all week last week, trying to hold on to those gains, and it has done so. So really, as long as the S&P chart's above 4,700, which was roughly the old highs, that chart is positive. And despite other internal problems that might exist, that does mean you should be holding a core long position and perhaps trading around it somewhat. The equity-only put-call ratios are bullish at this time. They both have rolled over to buy signals. Internally, things aren't as great as you'd like to see. NASDAQ now seems to be struggling, not only in terms of the composite index, but in terms of the NDX 100, which has fallen back a little bit as well. Even on Friday, the S&P was down, but breadth was positive on the New York Stock Exchange. So there's a little bit of divergence going on in a number of areas. And speaking of breadth, that's one of them. We see that our breadth oscillators are clinging to buy signals, just barely hanging on, but the New York Stock Exchange breadth has been the best of the lot. What we call stocks only breadth has been holding on a little bit, but NASDAQ breadth, looking at the NASDAQ composite, has really been quite negative. And a lot of people are expecting that the small caps will improve right now as the year has ended and tax selling has ended. We'll see. Could be. Usually that happens earlier, though. The tax selling abates back sometime in December, and those indices begin to outperform. But this morning, the Russell 2000 is outperforming on the opening, so maybe it will actually get something together more meaningfully. New highs versus new lows, again, those are positive on the New York Stock Exchange and negative on NASDAQ. So we're seeing the same sort of thing there as well. In the volatility space, the VIX spike peak buy signal is still in place. We got that, I believe, back on December 20th or so, and that's still holding in there. The trend of VIX is still a bit in question, meaning that the 20-day moving average of VIX is still above the 200-day. If it crosses below, then that would also be bullish for stocks. The construct of volatility derivatives, meaning the term structure and those sorts of things, that's still positive. That's really been one of the most positive indicators we've seen all through the last couple of months, even when there's been some selling in September and early December. What I guess the overall picture is that the seasonality, positive seasonality, still lasts through today and tomorrow, which is what was called the Santa Claus rally, as defined by Yale Hirsch. And once that ends, we'll see where things stand. But typically, even when there is a divergence coming into January, it doesn't take hold right away. It takes maybe later in the month, even a last reflex rally into February. And then, as happened in February 2018 and February 2020, you get some heavy selling. So that could happen here. I'm pretty confident our indicators will pick up on that before it happens. But right now, we're not really showing any sell signals per se. I'd say the closest thing to a sell signal is breadth. If breadth can't expand from here, especially New York Stock Exchange breadth, then we're going to have some sell signals in the short term. But right now we're holding a long core position, and we'll trade around that as as the indicators dictate. So have a great week and Happy New Year.